Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profits newsletter, coming to you from another nice day down here in Central Florida. This is one of my favorite times of the year. There's a lot going on. Of course, the sports world is exploding. But what's really exciting for me as a transplanted Floridian, I love this time of year as it starts to get cooler up north, and I can start sending the weather reports from here in Central Florida up to my friends in places like Detroit and Boston, where it's already the thermometers coming down, and we're seeing 50s and 60s during the day and a high below 70, and it just gets better for me. When you get into November, I just am starting to have a lot of fun when it's still 90 here and it's 55 degrees up in Baltimore, and my daughter's dealing with the cold and the rain and all that. I just love to send her a gentle reminder from Dad that she really should have moved to Florida when we did. But anyway, quiet week in the markets. Really, was just kind of surprising given all the garbage and news and stuff that happened last week. The S&P 500's up about 0.8%. The All World Earth Index is up just about 0.6 of a 6.5%, and our community bank index saw a little bit of weakness last week as it was off just about 0.6% during the week. So it was a big week. We had a lot of news last week. We had Janet Yellen. She confirmed that interest rates will stay low for a considerable period of time, but there's not really a definition set in stone of considerable. So what's going to happen next with the interest rate markets and the Fed depends on the meaning of the word considerable. That's going to be dictated by economic activity. I suspect that both on the housing front and the jobs front, that's going to continue to be slower than the Fed might expect, certainly slower than I think most of the economists expect. So you may just be extending this low interest rates further and further out there, in my opinion. I don't think that the economic activity is actually all that robust. But as with all predictions, and most certainly all of mine, don't trade or invest based on that because it's a good chance I'm wrong. We had the Alibaba IPO, one of the largest IPOs ever, as investors rushed to throw money into a Chinese, actually a shell that owns a portion of a Chinese internet company where the board of directors is dictated by a government very hostile to U.S. interests. But anyway, the deal was done, $22 billion. They've got all sorts of expansion plans. Watching Jack Ma was just hysterical. What a happy guy he was when that deal got done. I wish Alibaba and Jack Ma all the best, but I would never invest. A, the valuation is ridiculous, and B, I just don't see how investing in companies in China or Russia or other places that just don't have our best interest at heart makes a lot of sense for my portfolio. So that's behind us. The Scottish vote is all done. Not really surprised by the 55 to 45% margin. At the heart of this whole thing was, reallocating, collecting and reallocating taxes to deal with the fact that there's not a lot of jobs in Scotland outside of the oil industry right now, and massive percentages of the urban populations in Scotland are in fact on welfare. So this was about control of the welfare system, and I just did not see that ending well for the independent side. They really need the backing of England, the currency, the membership in the European Union, and of course the military coverage that being part of the United Kingdom gives them. I understand the impulse for independence. As I've said often, if I could secede, I'd put a fence up around the house and I would be the nation of Tim. But it's not economically viable. Secession's just not going to work in most cases in the modern world. It was fun to watch, though. So what are we going to focus on now? These were the big three for the past month or so. The Ukraine has quieted down. That's probably temporary. The Gaza situation in Gaza has quieted down. Of course, in Syria and Iraq, it hasn't quieted down, but it's not going to for a long, long period of time. And there doesn't seem to be a spillover into the economy at this point. So what are we going to talk about and worry about over the next few weeks? Well, we do have earnings season kicking off in 2 weeks. We're going to get that snapshot of how we did in the third quarter. And people are going to make massively stupid bets based on their guess about the guess of Wall Street's analysts on how a company did in a very short period of time. And that's always fun and interesting. From a value perspective, we're hoping to see, another nice, great big blow up that takes 50% off the price of a valuable collection of assets so we can jump into it. Didn't really get one last quarter. Maybe we'll get one this quarter. We'll see how all that plays out. The retailer earnings are going to be especially interesting for me, as are the regional and larger banks, because the days of just making your number through stock buybacks and loan loss reserve releases are coming to an end. They don't really have that many reserves to release. Could see some weakness in those numbers as a result. Now, once we're done talking about that, and that's going to be a dominant topic, but so is mid-season elections. They're only 7 weeks away, and I can tell you, living down here in Florida, the claims and counterclaims of all these politicians are getting more and more ridiculous by the day. And I'm a political and news junkie. I love watching this stuff, but these commercials that are just simply attacks on the other party or the other candidate are very tiresome, folks. Let's hear some ideas. I'm really afraid, and I don't usually talk politics, but as long as we continue to elect people from two parties that are incredibly similar in maybe not rhetoric and dogma, but certainly purpose, I don't think we get very far. It's time for a rethinking of electing these folks. If you watch these commercials and realize what professional career politicians most of these folks are, you're tempted to go to the poll and cast a none of the above kind of vote. But anyway, the dogma, rhetoric, political posturing, pro-business, anti-business, tax, anti-tax, that's going to dominate some of the news flow, and the market will trade based on how control of the Senate goes, probably very much so. We'll see how that plays out. It does have some ability to move the market, and a huge ability to make me sick, tired, and disgusted of U.S. politics by the time all this is done. Anyway, I've been playing with the Zacks backtester all week long, and to the point that my wife yelled at me a few times about getting out of my little cave and rejoining polite society. I downloaded it. I was trying to test the idea of buying stocks under book value that had a positive earnings surprise. Well, Zacks is the king of earnings surprise and estimate revision data. So I logged on and I saw, hey, this research thing that they have had a free 2-week trial. So I'm just going to try that and see what fun I can have. So I downloaded the thing. I got started playing with it and just kind of never stopped, because it's only a 3-year back test data that's in the Research Wizard. Not sure I'm going to subscribe, because I'm not sure that 3 years is enough data for me to spend a meaningful amount of money on. But boy, I've sure had fun with it in the short term. Now, we ran a lot of screens, and it was kind of fun to see just how much some of the value strategies that we use have outperformed the broader market over the last 3 years. I mean, I know it by looking, at account balances and performance and things, but of course, over the last 6 to 12 months, all that's really slowed down. And in this short-term world, I mean, geez, 2-3 years ago might as well be forever ago. But anyway, over the last 3 years, this thing goes back to September 2nd, 2011, as far as your backtesting ability. Our perfect stock strategy, that's below book value, low debt, high current ratio, positive earnings, positive dividend yield. Those stocks combined with a 1-month rebalancing have outperformed the broader market by a factor of 2. So has the Walter Schloss screen. Below book value, strong balance sheet, high levels of insider ownership. The thing we went to originally test, by the way, was stocks below book value that had posted a large positive earnings surprise. That screen worked very well, compounded about 50%, let's call it 40% better than the broad market over the past 3 years, earning about a 30% average annual rate of return compared to the market's 22%. That's pretty good. Now, the one thing that surprised me was I got in there and got playing with this, and of course, Zacks has all this great data on analyst upgrades. Stocks below book value that had a positive analyst upgrade underperformed the market. The earnings surprise outperformed. So here's your scenario. It's a cheap stock. Nobody's noticing. It has an earnings surprise. Investors, pile into the stock because of the earnings surprise. And 5 or 6 weeks later, the analysts finally notice it after the stock's up 25 or 30% and go from, a sell or a hold to an accumulate or a buy. They're late to the party, as always in these value situations. But the analyst upgrades actually underperform the market as a whole, revealing once again that it's not a lot of value to most of the Wall Street research that you see. It can be informative, but it's mostly a sales and marketing tool, in my opinion. Having worked in the brokerage industry for more than 20 years, that's basically what we use research reports for, was marketing material and sales pitches. So keep that in mind when you're reading Wall Street research. The biggest problem that we have as value investors today is, although all these things, perfect stocks, the Walter Schloss stocks, certainly outperform the market, there's just not that many of them to buy right now. We've been running screens, ran them again just this morning, and we're coming up with just a small, tiny handful of safe and cheap stocks at current prices. Now, what's interesting is if I look just a little bit higher and I look for stocks trading with, say, 90 and 125% of book value, we get another 100 or so stocks between those two screens that are suddenly safe and cheap enough to buy. So if you ever wonder why I'm such a cheerleader for a stock market pullback, it just expands the universe at a very rapid rate by 6 or 7 times the current opportunity set. And that would be a wonderful thing for a guy like me that's, I'm in my early 50s, looking forward to not so much as retiring as having the money to think that I can retire at some point in the future. One more decent sell-off would allow us to put a lot of this cash that has been piling up to work, and I look forward to it. It's going to happen eventually. I just don't know when. Now, the one screen that did outperform me, you guys are just going to be shocked by this because it's something I never talk about. The best performing screen over the last 3 years, the best performing subset of the stock market, has been small community banks trading at 85% of book value or less. They have earned triple the market's rate of return. Now, that's absolutely wonderful, but I'm here to tell you that I run that screen, I can get some money to work. We're about 75% invested in the guided portfolio in the regular banking on profit service. And with the weakness in the last week, we're probably going to see that ratchet up just a little bit here in the weeks ahead if it continues, because I'm getting some stocks coming down to the point where I want to be an active buyer of these issues and add them into the portfolio. So I don't know why you guys, those of you who are not involved in the small banks, I have no idea why. You should be. A portion of your funds should be in this. It's the closest thing, in my opinion, to free money you're ever going to see on Wall Street. Hopefully you'll take advantage of it. The opportunity is huge. It's going to last a decade, in my opinion, that you'll be able to make a ton of money in the small banks. So hopefully you get involved in those. It's outperformed, but we're just in the first or second inning of a very long game with these small community and regional banks. Okay, oil drillers. Been a lot of questions about this. Been buying them for the last several months. Obviously, the offshore drillers, Noble, Transocean, a bunch of those, they're getting crushed. Not much we can do about it. We can be scale buyers. These are really valuable collections of assets trading. It's 75% of tangible book value. Our day will come. However, right now the bears are having their day, and these things seem to trade off another percent or two every single day. Now, this is no fun. I've been through it before. Atlas Pipelines, Cons, some of these others where the stocks actually went down 50 and 60% before a couple years later I ended up trading out, with 2 or 3 times my original stake in the thing. It's not fun in the short term, but I have a high degree of confidence in the value of the underlying assets. So the only way to deal with this is, of course, be a scale buyer as things come down. Don't be afraid to add to your position as they come down, whether you do it based on percentages or liquidation value or whatever your particular formula might be. Be a scale buyer of these things and keep that private equity mindset at the top of your thinking. Don't worry so much about today's short-term quotational loss in these things. They're not going out of business. For the most part, they're not going bankrupt because they are financially sound. So just keep your eye on the prize and think that 5 to 7 year time frame, when eventually the global economy starts to recover a little stronger than it has been. Oil and gas demand goes up, day rates go up, drilling rig usage goes up, and these stocks are a lot higher. Short term, no fun. Long term potential is still there. Take advantage of the weakness, I think, to be a buyer of the oil drillers, particularly the offshore drillers at current prices. They are incredibly cheap right now. Okay, we've got something new for you guys this week. We're coming out with a new report. It's going to be a monthly service called the Bottom Decile Report. Now, whenever you get a bunch of quants, wonks, and other academic types together talking about stocks, they talk about deciles. When Feynman and French pretty much started it, they broke the market into groups of 10 based on a particular parameter, and those groups were called deciles. So we're going to deal with the bottom decile of stocks as ranked by price to book value. So we're going to look at the 10% of stocks that are the cheapest each month based on just their price to book value, and we're going to run all sorts of statistical and informational screens and publish these each and every month. So we'll be looking at things like stocks that trade well below book value and pay high dividends, have insider buying where institutions are accumulating the stocks. We'll be looking at those cheap stocks below book value that have high Piotrowski F scores and high Altman Z scores. That'll be a permanent feature each month, by the way, because those are two indicators that I think are incredibly reliable for financial condition and potential performance. So we'll be looking at all that stuff. Each quarter we'll do a 13D review. We'll look at all the smart money managers and see where smart money's buying cheap stocks. We will look at a bunch of other different factors. This month we featured what I call double cheap stocks that are trading both below book value and have an enterprise value to EBITDA multiple under 5. So they're double cheap on the two top performing quantitative factors in the stock market. It's some pretty interesting names there. So it's just going to be full of all kinds of information dealing with that bottom 10% of cheapest stocks where all academic studies and real life experience tell us the best returns come from. So all this information delivered right to your email box every month. Now, somebody asked me the other day, oh man, I could duplicate all that myself. Can I? You can. You really can. It took me about 20 hours to put this month's report together, and I counted them, 6 different research and screening and informational services that have a total cost to me of about $1,500 a year. So for $1,500 in 20 to 25 hours a month, you can just put all this information together yourself. Or you could sign up for our new bottom decile report, and I think we're going to charge the whopping sum of $99 for the year. And the marketing types are going to lean all over me. We'll probably have some discounted introductory offer thing. They'll want to give it to you. I wanted to mark it down to 98, and we'll meet somewhere in the middle. But we're going to have all that out this week. $99 for all that information about the stocks that have the potential to provide the highest returns for patient, disciplined value investors, delivered right to your email box. I think it's a great project. I'm really excited about it. I think it's going to be a very valuable service for value investors. So be a link out to you guys sometime this week so you can find out more and hopefully sign up and join us with the bottom decile report. And by the way, deep value subscribers, you get it free. That's just the way I work. I don't do add-on selling once you have our premier service. So if you're already a deep value subscriber, that report will hit your inbox Monday, maybe Tuesday if I have to yell at some folks to get the technology done and get it out to you. But you'll have it in your inbox this week. Okay. Moving right along, my Baltimore Orioles on cruise control. We won the division. We're still up by 14 and a half games, I believe. Just a great time to be a baseball fan, especially a Baltimore Orioles fan. We haven't won the division in 17 years, so this is a lot of fun for me. Detroit, you guys might have clinched it this week. They've taken 2 out of a 3-game series from Kansas City. They play another one today. Should they win that one, 3.5-game lead with just a few games left, I think Detroit's going to be okay on the division, and eventually they will have the honor, depending how this thing stacks up, of losing to either us or the California Los Angeles Angels. So we'll see how that plays out. College football, not a good week for me. Navy lost, unfortunately, to Rutgers. Kept it close, played well, but they did, in fact, drop the game to Rutgers. Florida, I adopted the Florida Gators. Boy, was that a mistake. They got clobbered by Alabama. They looked horrible. Jeff Driscoll, not playing well. Even Emmitt Smith is tweeted out calling for the guy to be benched. I'm not sure what they have behind him. This kid was supposed to be a great quarterback. He has not shown it in college. So could be some big changes coming at the Swamp in a relatively short period of time. But at least I did not adopt the Florida State Seminoles. That's a really good football team. But, Jameis Winston, get it together, kid. You've got a multi-million dollar fortune ahead of you. Unless you continue to blow it with all the focus on behavior in the NFL, your draft stock is dropping like a rock. Start playing football, keep your mouth shut, pay for the stuff that you buy, okay? Much more comfortable with my losing Florida Gators than FSU and all the problems they've got up there. Although they did win yesterday without Mr. Winston, who was suspended for a game, but that young man really needs to get his act together. Okay, moving along, not much on the book front this week, unfortunately. Very slow week. That gives us a little time to digest all the stuff we've been buying the past few weeks, and it really kicks off that first week of October. There's just a flood of great books coming, so be prepared. Now, what do we have this week? Shinzo Abe of Japan, the Prime Minister, will be giving a talk at Columbia University at the World Leaders Forum. That could have some impact on the Japanese markets. We've got, this one is obviously of high interest to me. We have the Federal Reserve Community Bank Conference going on this week. I'm really looking forward to what comes out of that. Should be some talk of regulatory relief and mergers activity and all sorts of fun information we can use to make some money. Speaking of banks, Citizens Financial, Royal Bank of Scotland, is doing an IPO. I understand it's going to be the largest bank IPO ever at $14 billion of that U.S. banking network that they're selling in the IPO. I'm kind of watching the price in there. Obviously not going to do anything with it because it's not going to be priced at a level that's going to attract my attention. It will be interesting to see how enthusiastically it is received by the stock market. So I will be watching that. We have existing as well as new home sales during the week. Expect to see weakness in the numbers. It's not going to be anything spectacular. Might be a little better than it's been because it's summer selling season. Still not going to be anything in there that says that housing is going to lead the economy forward. I've said it before, say it again. The economy has to lead housing. Housing can't lead the economy. So, but those numbers will be out. They can always move the market a little bit, as can the durable goods report, which will also be out Thursday. Okay, I'm a huge baseball fan. I am not a New York Yankees fan. But if you're a baseball fan, you have to have an enormous amount of respect for Yankee shortstop Derek Jeter. He's been a great baseball player. He has conducted himself with just so much class and respect for the game that he plays and the team that he plays for. He plays his final home game Thursday at Yankee Stadium, and what an emotional, wonderful moment that is going to be. The Yankees are probably not going to make the playoffs. They're far enough back in the wild card that it would take a miracle. So this could be it for Derek Jeter at Yankee Stadium. I, for one, will absolutely be watching that baseball game. If you're a fan, you should be as well. All right, that about wraps it up for us this week. The wife and youngest have gone out to watch some movie about a dolphin. No idea. I guess it's the second movie about the dolphin. So they're off. They'll probably take some little mall time afterwards, leaving me and the dog an afternoon of some of our favorite things. Hanging out on the couch, doing a little reading, and watching some football. So that's what we're off to do, and we will talk to you next week. And again, look for that bottom decile report to come out this week. It's going to be the best way to stay on top of the world of safe and cheap stocks. I'll talk to you guys next week.